Because what you, the unsung heroes in the wastewater industry, do matters. Join me, Suzan Chin Taylor, the Doo Doo Diva, a longtime veteran of the wastewater, trenchless, and civil infrastructure industry, each week as I deliver industry know-how from industry pros who know how. Whether you want to learn about the latest trends in technology, training and retaining great talent, sales and marketing, leadership and growth, or simply how to be more efficient, productive, or profitable, this podcast is for you. Let's dive in.
Well, hello, everybody, and welcome to this week's episode of the Doo Doo Diva Smells Like Money podcast. And we're continuing our visit with Steve Selengut to talk about the subject of money and financial wellness and health. And today, Steve is going to be sharing some secrets from his book, Retirement Money Secrets. And this is a book really designed for helping those of us who may not be that familiar with how to prepare for retirement, our financial health, income streams, ensuring that we're going to be okay when we retire or exit from our business. And, you know, without not giving, no spoiler alerts here, but we're going to highlight some of the tips of just DIY things that we all need to be aware of. And so with that, Steve, take it away and tell us like some of the really key highlights from this book that, one, we're not trying to sell books here, folks, but the book is really, really great. But just to kind of give you a taste of things that you should be prepared for if you want DIY.
Okay. Do it yourself invest. I have two Facebook groups, and one of them is called Closed End Funds for Retirement Income and Equity Trading, and the other one is the Retirement Income Independence Coach. And I would say that 50% of the people are in both groups. So, but there are a couple thousand people who exchange information about do-it-yourself investing, and it's a community where they raise questions and everybody participates in the answers, and we really work together well to educate new people who raise questions. And what it all boils down to, and one of the things that the book, I don't know if you knew this, and I don't think I even mentioned it in the book. The book was actually created at the request of one of these groups. We got to put this in writing. We got to do this. Mm-hmm. And I said, no, I've been there, done that. I don't really want to do another book. So finally, a dozen or so of us got together and we had some meetings and we set up an outline of what this should do. And we asked questions of the group members who were do-it-yourselfers, and they said, this has to be covered. This has to be covered. So we boiled it all down. We even developed a pyramid, a financial risk pyramid designed just for the closed-end funds that we were using and so on, so that people could really, really go and dig in and do it themselves and have as little fear as possible in a new event as you could, So the things that are covered in the book that are really applicable to starting a do-it-yourself mode, or actually maybe even if you are a do-it-yourself investor, slapping you up alongside the head and say, this is what you should be doing. Okay. So there are 6 basic principles, 4 of which are about risk minimization, financial risk minimization. How do I keep from having an Enron situation or a Merrill Lynch, Lehman Brothers thing that actually brings me to my knees, that ruins my prospects? What steps can I take? And in those 3 instances, unfortunately, you could have taken all these steps and still had those securities. But that's not the point. The point is there are 4 basic risk minimization tools that everybody should apply to their investment portfolios, whether they're doing it themselves or planning on eventually doing it themselves. And the first of these, what's job 1? Everybody knows what's job 1 from Ford commercials. Quality is job 1. You said it in our first episode, never invest in anything you don't understand. That's part of quality. You got to understand it. It's got to be a company or a security that's been around for a long time. You've got to, it's got to pay you some form of income, be it interest or dividends or distributions in the case of closed-end funds. In the case of a fund, it itself has to be a diversified entity. You can't have a fund with just 22 positions in it or seven. It's got to be over 50. In the closed-end funds that I use, my average is almost 200 different securities inside each fund. It's been around, its distributions are regular, and so on. So quality is always job one. The next thing that's important, and anybody who's listening to this should take a look, put it on pause, get your portfolio out and look at how much money you have invested in individual portfolios. Diversification globally, by industry, by type of security, sector, number of securities in your fund, and so on. Diversification is the second of the two great risk minimizers. If most people will look at their portfolios, I've seen $1 million portfolios in my coaching career, short coaching career, which would have $1 million spread over as few as 2, 3, 4 different securities. In other words, if one of those went bankrupt, they'd lose 25% of their assets. You just can't take that kind of risk. Classic textbook diversification is no more than 5% in any one security across your portfolios. A lot of people will have exactly the same portfolio, same securities in 6 different portfolios, the same thing, that type of thing. No good. 5% maximum. My portfolios, and I have a significant size portfolio. I have no more than 2% invested in anything. I always used to use the example of the Enron situation. When Enron happened, my wife had 100 shares of it in her IRA or 200 shares in her IRA, and she never knew because it was such a small piece of that portfolio that it didn't make a difference. And that's where you want to be. Everybody has a different level. I have a certain maximum dollars that I would really be upset if I was stupid enough to lose it or if something happened that made me feel stupid enough to lose it. So I have a number, and everybody should have that kind of number and never have that much money in any one security. When I see 6 figures in a individual security in clients' portfolios, even if I'm not meeting them for a week or two, I'll send them a note and say, hey, you don't want that. Sometime between now and when we meet, the market could crash and you're not going to be happy. So diversification. Thirdly, income production for several reasons. That's what you're going to live on eventually. That's what you want to grow year after year, quarter over quarter. You want to grow it. And also, it's a test. If you have a company or a fund that is paying you income and all of a sudden it lowers its distribution rate or cuts its dividend entirely, there's something wrong. They're not going to want to do that type. If you own nothing but high-tech NASDAQ companies that don't pay any dividends, you have no way of knowing if one of them's in trouble because they don't pay any dividends. So you want to limit your exposure to that kind of risk by knowing everything that you have is paying you some income. Also, with the income, you want to be thinking about how much income am I going to need from this portfolio when I need to start using my portfolio for income. So you need an objective for that income. And you can reach that objective sooner by using lower risk, higher yielding securities from the get-go. When I used to manage money for people, and I managed a lot of it, every client, every portfolio had at least 30% of that portfolio in income purpose investments, regardless of size. The older they got, the more income focused they became. And that was, if they didn't like that, then I had to fire them. And I fired a couple people in my time. But and some people fired me. That happens too. But anyway, not many. So, okay, so that's the 3 of 4. Now, the 4th one is the hardest one to bring home to people. And it's really the most important because what really represents is the second stream of income that most people ignore. It's like that $100 bill on the sidewalk. You don't walk by it, you pick it up, right? Everybody picks that up. In the stock market, you get opportunities to take profits. It's the same thing. That $100 bill may not be there tomorrow. It may not be there later today in the stock. You have to have a disciplined approach to profit taking. You have to set targets, just like your Imagine your portfolio was a department store and you set a markup on every product in every segment on every floor. There is a profit target. None of those places are saying, well, we'll see what the market will bear. Well, they know exactly what they want. And when somebody comes in the store, they sell it and they put another product back on their shelf. That's the way of looking at profit taking. You gotta be a business person with regard to your portfolio. It's your business.
I like that because you were saying that to look at, focus on an income vesting, almost like even if you're just an employee, that your portfolio is almost like owning your own business. It's like you're an entrepreneur of your money.
Exactly. In two senses. The sense that, in a sense, if you have all these closed-end funds that are paying you 6 and 7 and even 10%, they're like employees producing money for you, right?
Right.
And if they stop producing money for you, that's when you start thinking of getting rid of it also.
So when you say taking profit, okay, so you take the profits, what does that mean? And then if you take them, then what do you do with them?
You reinvest them.
Okay.
In more inventory. You might broaden your base, buy more closed-end funds, buy more stocks if you're in dividend stock, or add to ones that have gone down in price. Because remember, they're all high quality. They're all well diversified. They all produce income. So you don't have to have a fear of them going down in price, because that's the natural movement of the market, up and down, forever. There's never been a rally that hasn't been replaced by a correction, and vice versa. And if you've got the quality, doesn't really matter to you. You can take advantage of it. And that's the next principle. We are living the stock market, the bond market, the whole universe of investment is a cyclical beast. It goes up and down. The only thing we don't know is when it's going to do what. It's unfortunate, but we can tell where in the cycle we are. For example, right now we know the stock market's been at all-time highs recently. So we know we're at a high level of the stock market. We don't know how much more it's going to go up or when it's going to go down, but we know we're at a high. So if we're buying stocks or stock-based securities, we buy less of them so that we can add to them when the prices go down. If it goes up, we'll sell them. If it goes down, we'll add to them. On the bond side, it's a whole different cycle because it's a function of interest rate expectations. Where is the Fed going next? 2 weeks ago, we knew they were going to lower the rate a second time. Today, we don't know that anymore. So over the last 2 weeks, interest rate sensitive securities have gone back down a little bit because of that. So now they're yielding even more than they were. Okay. So cyclical nature of the investment markets. You have to be able to take advantage of the cycles because you're not going to change the beast. It's always going to be cyclical. The final principle that we cover in the book is a mindset issue. It's your mindset. Most of us have been brainwashed into thinking that the market value of our portfolios is the only thing that matters. Think about it. Anybody listening, think about it. What's the first thing you look at? Is your market value. The first thing I look at is my income production. How much income came in this month? How did that compare to last month? What is my projected income for the next month? What I want to see, and companies like Fidelity and Schwab, they'll actually have that information in your portfolio statement. They'll say projected income for the next 12 months. And I keep track of that. I keep a spreadsheet for my 3 portfolios, and for each one I keep track of the projected income, and I want to see that projected income going up every month. That means I'm getting more income in than I'm spending, and I spend a lot of money because I've been able to reinvest enough to continue to grow the income. And that's what you want to see in a portfolio if you're doing it yourself. You want to see the income growing every quarter and every year. You want to see what I call the capital, the amount you've invested and reinvested into that going on. I'll get back to that in a minute. And finally, the projected income growing. And you notice I didn't say a thing about market value just then, because market value is what the markets dictate by their cycles. What produces income is the capital that you've invested for income, not the market value of that capital. If my capital is $600,000 and the market value goes down to 4, it's still producing the same amount of income. If it goes up to 8, it's still producing the same amount of income, unless I take the profits and add to the capital that's invest.
Mm.
So there. I still would like you to go out and buy the book, but I've just told you most of
Yeah, but it doesn't hurt to have it as a reference or to join the Facebook group. And this has all been great
it.
because it's given me a lot of food for thought. Because I'd shared with you, I got burned by a broker years ago. And it was probably because I didn't, as we said in the very first episode, to really give clear directive as to what I wanted from that financial advisor and
Yeah.
setting those expectations of him or her as to what I wanted to achieve out of giving you my money to invest.
Right.
That
They are working.
you're
They
going
are
to choose,
working
they're
for
working
you.
for you. And that was the big thing. And so, Steve, thank you so much for all of your wisdom and spending all of this time, with me and with the listeners. I learned something. I hope the listeners learned something. And so, yes, I know that this is not wastewater related, but you know what? There are so many of us in this industry that are getting ready to, either silver tsunami or we're getting ready to retire out. And I want to see my colleagues in this industry who have really, given of their lives to their communities. I want to make sure that you're going to be retiring comfortably, safely, and you're going to have some reward at the end of your days of really working hard to make sure all of us have a safe community, have clean water, have great sanitation, because you deserve it. At the end of the day, you all deserve it. And so take Steve's advice and make sure that you have these things in place so you can live comfortably and enjoy the fruits of your labor. And so with that, look up Steve's book on Amazon, Retirement Money Secrets by Steve Selengut. Check out his Facebook group. Look at his, repeat for us your website with the coach. What was that again?
Theincomecoach.net.
Great. And thank you again for tuning in, and hope you got a lot out of it. And until next time, keep it flowing.
Be sure to subscribe to the show so you'll never miss an episode. If you're an industry expert and would like to be considered as a guest on the show, click the Be a Podcast guest link below in the show notes for more information. Thanks again for joining me, the Doo Doo Diva, on this week's episode of the Smells Like Money podcast.